Hello, everybody. Welcome back to the Financial Modeling Bootcamp presented by the Market Information Lab. My name is Jacob, and I'll be walking you guys through week 2 of the 9-week bootcamp. Thank you guys for coming back, and hopefully at this point you have practiced the Excel keyboard shortcuts that we worked through, and you're pretty familiar with some of the formatting that we talked through last week. This week we'll be going through the financial statements. Financial statements are really important for doing valuation and performing the evaluation that we're going to be doing later on throughout the course. So it's really important, base knowledge that we want to establish here before we get into it further. So a review, 9-week bootcamp. Last week we went over Excel, and this week we're into financial statements. A quick overview of the different financial statements. So, what are financial statements? Financial statements, and where can they be found, right? So the 10K is most common source for these financial statements regarding public companies. It's very hard to get financial information around private companies. However, all public companies are required to put out their financial statements for potential investors. Or if you have a public debt offering as well, you will also see their financial statements published for investors, right? So this could be stock classes, auditors reports. A lot of it comes with additional discussions from management or talking about risk factors that impact the company. So that kind of goes into the overview of the 10K. Additionally, you'll actually see the financial statements attached. As you can see, you'll see the balance sheet, the income statement, cash flow statement, statement of shareholders equity. All of these are required for them to be a public company. So oftentimes the 10K is a really great place to go to find this dense information full of financial statement information. So whenever you're going towards building out a valuation for a company, we highly recommend at least glancing through the 10K, reading more about the management and kind of their discussion of what has happened within the year, and also kind of the key risks and factors that go into this company, as well as looking at the financial statements and some of the performance, right? So the income statement, balance sheet, cash flow statement, those sort of things. Often really great place to start whenever you're looking at building out a financial valuation, Excel, or going through towards valuing a company. On to kind of the income statement. So the income statement is one of the three main financial statements that we use. So, what is an income statement? Basically, it shows you the performance over a year, right? So a lot of times it is over a year, but it could be over any period of time. It could be a month, a week, etc. And what it's going to show you is the dollars coming in, which is called revenue, and then the dollars going out, which are your expenses, and then the tax for that period. So essentially what it's showing you is in that period, how is the company performing, right? How are they bringing in money? How are they spending this money? And how much money is left over for the investors? The money that's left over for the investors is what is actually going to help determine our value. Top line often, when we call it top line growth or top line statement, that is usually indicative of sales, right? So sales or revenue, whatever you want to call it, is how the company makes money, right? So this could be subscriptions, this could be selling an item, this could be ad revenue. All of these are possible sales or revenue line items. And this is eventually what is going to be netted against your expenses to get net income. What appears on the income statement? So in order for it to appear on the income statement, it must correspond to the current period, meaning that if it happened this year, it needs to be on the income statement for this year. So you can't have something that occurred 2 years ago show up on the income statement this year because it's not related to this period. Another thing is it needs to be tax deductible. So a lot of things that we'll see throughout the course and even talk about today are not always tax deductible. So for example, if you buy a property or a piece of equipment, that's not tax deductible. So you won't see that on the income statement. However, you will see depreciation or expenses on the income statement because that reduces your taxable income. And that's why it shows up on the income statement. So one of the things we want to talk about here is revenue recognition. This is a very high level overview of what revenue recognition is, but it's really important to know for valuation purposes. And for example, you recognize revenue when the service or good has been performed. So if you have a bonus, whether it be for performing X amount of sales over the next 3 years, you cannot recognize that revenue today, even though you got paid today. you'd recognize that revenue at the end of year 3 or whenever you've sold enough items to claim that bonus, because that is when you performed the service. Same things goes for the companies. If you pay $60 for your subscription for Netflix, Netflix can't recognize that revenue until the whole year has been performed, until they provided you a service for a whole year. This is really important because revenue recognition often is something that you'll work towards building out in a more complicated revenue model. Revenue, expenses, and taxes, right? So they're all tied to operational activities. You'll also see gains or losses on different sales and transactions. This will also occur in the income statement. However, it's not often projected out in these valuation models. Sometimes they don't have to be cash, right? So not all expenses are cash related. For example, you could have certain types of interest expense that is not paid in cash in that period. Another example would be depreciation and amortization. So they've already paid for the plant, property, and equipment in years prior, and depreciation is them recognizing that. So in the year, you reduce the value of the equipment because it's no longer worth the original value. However, that reduction in value is not actually costing you cash. So this is why we call it a non-cash expense. And we'll see kind of these other adjustments when we get to the cash flow statement. However, depreciation and amortization seems to be the most common non-cash expense, and this is why it's important to note non-cash expenses, because it doesn't actually impact valuation, right? Since it's a non-cash expense, that cash is still available, and this is also called a tax shield. So here's what an income statement looks like. You have your revenue and your cost of goods sold to get to your gross profit. Your gross profit is essentially the amount that is left over after your main operating activity. For example, if you're selling iPhones, this would be a great example for Apple. Apple's revenue is the dollars that you bring in from selling the iPhone, and the cost of goods sold is however much the iPhone costs. Gross profit is generally just shows you how profitable your mainstream business is, and a lot of times this is really only important to compare from industry to industry. You wouldn't really care too much about gross profit as a whole. You'd mainly want to compare examples from, like, you'd want to compare gross profit from Apple to Samsung or Apple to another cell phone provider to see how profitable is Apple in these phone providers, as opposed to just how generally profitable is their gross profit. Moving on, you'll see your operating expenses. So your SG&A, or selling and general administrative items. So this could be advertising, office expense, rent, legal, accounting, salaries of general workers. And then you have your other operating expenses. These could be, one-time charges, etc. This could also include depreciation and amortization. All of these things are then netted out. The reason that we subtract them out here and not in cost of goods sold is because this isn't specifically related to a certain selling practice, right? So this is all the items that are being subtracted here aren't specifically related to the sale of a single iPhone, but they're more regarded towards operating Apple as a whole. Then we'll end up at our operating income, otherwise known as EBIT, which means earnings before interest and taxes. So as you know, to get down to net income, we would have to subtract out the interest and taxes to get to our earnings. So that's exactly what we do. We subtract out expenses related to interest, and we add back any interest income that we may have occurred. Interest is essentially what you owe if you have debt outstanding. Basically, this is what you pay your debtor for letting you borrow the cash. That gets us to EBT, or your pre-tax income. The last thing you'll do is you'll subtract out your taxes to get to net income. And your taxes often is based on a flat percentage whenever you're projecting out an evaluation model. Here's an example of a real company. This is right out of Coca-Cola's 10K. As you can see, it follows very similar format to what we just showed you earlier. However, it has a little bit more detail as far as where some interest expense comes from, equity income, and you see some more complicated attributes as well. For example, it has like a loss from discontinued operations, which means they sold a business, or You may see they also have their basic income per share and diluted income per share. These are all per share data that they're required to disclose for the SEC, and you'll see this quite often. The balance sheet. The balance sheet overview here is pretty important. The biggest thing you need to know about the balance sheet can be found at the bottom. Assets equals liabilities plus equity. Basically, whenever you're looking at a balance sheet, it always has to balance. So that means your assets has to equal your liabilities plus equity. And this is what makes it really easy to build out a balance sheet, because if your assets don't equal your liabilities plus equity, there's something wrong. What essentially a balance sheet is a snapshot or a picture of what the company's balances look like at that point in time. So for example, a couple things that you may look for is on a balance sheet is things like current assets. So items that are going to be converted into cash within 1 year. These are going to be things like cash, accounts receivable, inventory. These are things that you expect to be sold within a year to give a benefit to your company. Non-current assets, these are items that are maybe more permanent in nature. So your plant, property, and equipment. For example, a big factory or plant may have a 30-year lifespan, and this is also found on your balance sheet. Current liabilities are basically the equivalent to a current asset, so these are obligations that you have to pay within 1 year. However, as opposed to an asset where it provides you a benefit within a year, a liability is going to be a cost or an obligation you have to pay within a year. And then your non-current liabilities are obligations that have a longer period to pay back, usually over 1 year. These can be things like debt or capital leases. So going a little bit deeper, an asset essentially is something that will give you cash in the future, has some financial benefit in the future. These are things like inventory, accounts receivable, and we do generally break all of assets and liabilities into these current and long-term. It's really important to show your investors when you expect these potential benefits to actually provide them a benefit. Some liabilities examples we've talked about, so that's accounts payable or accrued liabilities. Accounts payable essentially is the vendors you have to pay for your day-to-day operations, and accrued liabilities are things like wage expense or rent expense that you still owe, however you haven't paid yet. Shareholders equity is something that we haven't really talked about a whole lot, but this is essentially a residual account that shows just how much the company would have in case of a liquidation. For example, if you were to sell all your assets and pay all your liabilities, this would be the residual claim on that the shareholders have. Essentially, this is a funding source which shows just like where the company has got outside capital that is not a liability. So if you were to do an IPO or initial public stock offering, you would see shareholders' equity would increase because they issued shares and they took outside capital to fund their business. So a lot of times you'll see common stock, which is one way to increase shareholders' equity. This is more transactional. The company has to sell shares to outside to get these dollars. For example, if I have a stock and I sell it to you, the shareholders' equity on a company will not change because they're not selling it to you. However, if I go to Coca-Cola and buy a share directly from them, then their shareholders' equity would increase. Another way that you see shareholders' equity increase is retained earnings. So essentially when a company has net income or income after taxes, they'll increase this balance because this is residual earnings that they have. Retained earnings is also used whenever they pay out dividends. Dividends reduces retained earnings, whereas net income would increase retained earnings. Here's an example of Coca-Cola's balance sheet. As you can see, it's very broken out into each of the different subsections. As you can see, we have current assets, total current assets, other assets, total assets. And as you can see, our total assets is equal to our total liabilities and equity down at the bottom line. Other things to note, liabilities and equity. The liabilities are broken out into current and non-current, and as you can see, they have common stock issuance, retained earnings, and they also have a couple other line items to go in between, just because Coca-Cola is a little bit more complicated. The cash flow statement. So the cash flow statement is one of the statements I feel we have the least exposure to in the college business. But it's really important to know whenever you're building out a financial model, because this is what makes everything flow together and makes your projections balance. So the cash flow statement is extremely important because in valuation, cash generation is king. So you'll probably hear us say a couple of times throughout the valuation bootcamp that cash is king, and it truly is, because as an investment, you want to generate cash for your investors. So essentially what a cash flow statement does is it tracks over the period what happens in both the balances in your balance sheet as well as the financial performance of the company. And what this does essentially is two things. One, it's supposed to show where cash is coming into the business and where cash is going out. And this proves as kind of a reconciliation for investors to look at these items. Additionally, it's important to have a cash flow statement because you need to account for things like the non-cash expenses like we talked about. Depreciation is a reduction in PP&E. However, it doesn't actually cost you money in the year that is being depreciated. So it's important to add this back on your cash flow statement because this isn't an actual cash expense. And another thing that may be a cash expense that you don't see on the income statement and is counted in the cash flow statement but not the income statement would be dividends. For example, if a company was to pay out dividends, this is not on the income statement. However, you would see this on the cash flow statement. So it's important to pay attention to things like this. Another example would be capital expenditures. Essentially, what we're trying to see is how much cash is the company generating and how is it being brought in and how is it going out. It is a little bit different than net income, but still broken out in a very similar fashion. So the cash flow statement has three important parts: the cash flow from operations, cash flow from investing, and cash flow from financing. Cash from operations is just like it sounds. It's the cash inflows and outflows that are related to the operations of the business. So not only does it start with net income, it adds back depreciation because it's a non-cash expense, but it also has the adjustments in your current assets and current liabilities in this line item here. This will give you your cash from operations. Cash from investing is essentially that. However, when I think about cash from investing, oftentimes I think about buying stocks and bonds. This is not how a company invests their money. Companies invest their money through acquisitions, buying plant, property, and equipment, and other long-term investments. So that's what you can find here. So it'd be the cash inflows and outflows from those related activities. Finally, you have cash from financing. So this is more what you're thinking about in the investing with stocks and bonds. This essentially shows you not only the cash inflows and the outflows of raising capital or selling securities, but it also shows things like giving out dividends or paying off your debt. Here's a further breakdown that you guys can go ahead and read, and some pretty common line items. We've gone over a lot of this so far, so feel free to pause the video, read this a little bit. A big thing to note here is that goodwill is in cash flow from investing just because it's related to acquisition costs. Awesome. So, feel free to pause the video, read this a little bit more, but nothing we're going to really cover here. Cash flow from operating, the last thing I kind of want to cover here is what does it show us? Essentially, cash from operating shows us, how profitable is the day-to-day operations of this business. If you want to see a positive cash flow from operating in this business, because negative cash balance here is essentially showing us that our business is losing money from operations. This is not a good sign. You can have a negative net income and have a positive cash from operating. However, you really want to see both a positive net income and cash from operating. Essentially, some of the cash inflows is going to be a decrease in your asset balance, and a cash outflow as far as an asset goes is going to be an increase in assets. The way you need to think about this is if an asset increases, it costs cash to increase this balance. Liabilities is reverse. If a liability increases, this is a cash increase because you didn't have to expend cash in the current period to pay for this. However, if the liability decreases, this is a cash outflow because you had to pay off money to pay off the person you owed or pay off the liability. Cash flow from investing, right? So this is essentially where you'll see how the company is planning for the future. A lot of times you'll see capital expenditures, purchase of equipment, maybe long-term investments, maybe acquisition. If you're looking through this, you want to see you'll most likely see a negative balance, and this is not often a bad thing. If you don't pay any cash to continue to grow your business, this could definitely be a red flag. Spending money in cash from investing is definitely viewed as a good thing. Some cash outflows are going to be buying plant, property, and equipment, buying long-term assets, buying short-term investments, and the cash inflows tend to be the proceeds. So whether you sell a long-term or short-term investment, or you sell a plant, property, and equipment, this is going to be a cash inflow on your cash from investing line items. Cash from financing. So this is essentially the activities that are showing the sources of where the company is getting their cash from. So a cash inflow here would be a debt raise or selling securities. As an outflow may be paying off your debt or issuing a dividend. Another thing you may see here is minority interest, which is a more minute thing that we kind of talk about. However, it's important to know that if a company has less than 50% ownership of the company, this will show up here as a cash outflow. An example of the cash flow statement can be provided here. This is Coca-Cola's, and as you can see, there's a lot of different line items broken out here, and basically you're going to want to just look through this and try to figure out the story. As you can see, the operating activities, very positive. However, you see the investing activities tend to be pretty negative. And if there's a positive or negative that that you don't understand, you may want to look into it further. For example, the purchases of investments and the disposable investments makes the cash from investing positive. So as an investor, I'd be more interested in learning more about that, because I think that most of Coca-Cola's investments should go towards continuing to do their operations instead of buying or selling investments. This may be a possible concern as an investor. Some key takeaways in linking the statements. Essentially, all three of these statements flow into each other, and we'll see that very shortly. But essentially, the income statement will flow into the cash flow statement, and the cash flow statement flows into the balance sheet. All three of these statements talk to each other, and without each of the statements, you wouldn't be able to build out a great valuation model. So building out each of these statements is a really great place to start whenever building out a valuation model, because you're able to see how they work together and what drives each of them. Some income statement recap. So basically the income statement, there are two things you need to know. One, is it tax deductible? And two, is it within the period? If those two things come back as correct, it needs to show up in the income statement some way. This is also how companies show their revenues and expenses. The balance sheet recap. The balance sheet, most important thing to know here is that make sure it balances. That means your assets equals your liabilities plus equity. Also on the balance sheet, we tend to break things out into current assets and non-current assets, current liabilities and non-current liabilities. Then we have a residual account called Shareholders Equity, which can be broken into different items such as retained earnings and your common stock. Cash flow statement is really important because cash is king. We want to understand as an investor of this business where cash is going and where cash is coming in and coming out. This is the most important statement if you have to pick one of these, just because you can essentially see how profitable the business is just from the cash flow statement alone. How the three statements link is pretty interesting. The net income starts from the bottom of the income statement and flows to the top of the cash flow statement. You will essentially add back all non-cash expenses from the income statement, and you'll flip the signs of any gains or losses. So if you have a gain, you need to subtract this out here because it's not related to operations. This is more related to investing activities, which will be added back later. Reflect any changes in the operational balance sheet items. So if any of your current assets or current liabilities or increase or decrease, you'll see this reflected here. Reflect purchases of sales of investment and PP&E. So if you flipped any signs, you're going to add back the whole sale of the investment here. Additionally, if you're buying any equipment, you need to subtract this out here. Dividends, debt issuance, repayments, shares should be all subtracted out here, as well as if you have any cash inflows, this will also be counted here. This will all go into the calculation of the ending cash balance. That cash balance will flow to the top of next year's balance period, and this shows your cash balance. After you update all of the balance sheet items with the changes in in assets, liabilities, debt, equity, investments, etc. This will all end up totaling up to equal your assets equals liabilities plus shareholders equity. How the three statements link continued. So as you can see, this is maybe a more broken down part to show where do each of the balance sheet items link into the cash flow statement. So as you can see, cash is into the top and bottom line of the cash flow statement. You have all your current assets is the cash flow from operations. Short-term investments is cash from investing. PP&E is investing activity. Goodwill is an investing activity. Intangibles, investing activity. This is a really great cheat sheet to look back on if you're trying to figure out how to link each of the specific parts. Similarly, if you go through liabilities, you have your debt is a financing activity. Your accounts payable, accrued expenses, and deferred revenues are all operating liabilities, so this would be cash flow from operating. Your long-term debt, common stock, treasury stock, all financing activities, and your retained earnings is your cash flow from operating, because this is a residual amount of how much you earned over the year. Now we're going to go ahead and dive into the Excel exercise for today. So feel free to pause the video and pull up the Excel exercise. Hopefully you've pulled up the Excel exercise for today and become a little bit more, more familiar with Excel due to the last couple of, the last week's class and exercise. Hopefully you've had time to practice and practice your keyboard shortcuts. As we do these exercises, I really encourage you guys to not use your mouse because it will save you more time in the long run. I know learning these shortcuts is not easy. However, if you learn these, it could definitely save you a lot of time. In the long run, just being able to work quickly in Excel is something that all people who are working in finance should be able to do. So here are the instructions for today. We want to link all the financial statements by filling in the boxes. Most items can be found using formulas, or we talked about them in class. You'll also know if this is correct if the balance sheet balances. So I want everybody to go ahead and pause the video here and go ahead and try to link all three of the statements. If you struggle or you're not getting it to balance, feel free to resume the video and we'll walk through it all together and I'll go through a more detailed explanation. But just a reminder here, feel free to pause the video, take a stab at this on your own, try to link the financial statements. Again, if you're having troubles, feel free to come back to the video, watch and do it with me just in a second. I'll be right back. Okay, so hopefully you have had at least a chance to practice or you've tried to link all three of the statements. Maybe you're having a small problem. We're going to go through it here, or if you wanted to just wait and go through it with me on your own, that sounds great. If at any point in this video you're going a little bit too fast, feel free to pause the video and rewind, practice again. Practice always makes perfect whenever doing these three statements, and the more you practice, the better you're going to be. So we're going to go ahead and get started. So I'm going to go with control page down to toggle to my income statement. As you can see, the income statement is all completed for you. We have our revenues less our cost of goods sold to get our gross profit. Subtracting out SG&A and depreciation gets us to our operating profit. Interest expense is less interest expense to our operating profit is our pre-tax income, and less our taxes leads us to net income. I don't see anything we need to fill out here. We need to just move into our cash flow statement. If you remember back to the slide, the first thing we need to do is link our net income into the cash flow statement. So I'm going to control page down twice and skip all the way ahead to my cash flow statement. As you can remember, first thing that we need to do for a cash flow statement is plug in net income. So I'm going to toggle down and type in net income. And as you can see, the first thing we have here is a green number. This is showing us that we need to link this to another tab. So the way that we're going to do this is do equals, control page up twice, and I'm going to just grab my net income for 2018 here. As you can see, it's already formatted green and has a dollar sign, so I don't need to format it any further. Green, again, just shows that it's linked to another tab. Depreciation is already pulled in. Now this should also be green because it's linked to another tab. However, we're just going to flow with it. Change in inventory. So our change in inventory is an extremely important thing to walk through. All of your assets, if they increase, will decrease your cash. And if the asset decreases, this will increase my cash. So that's important to think about as we go ahead and build out this formula. So I'm going to do equals, control page up, and I'm going to go down to my inventory. Now my inventory here decreased. So because it decreased, I want to show a positive balance in my cash flow statement. So I'm going to take my 2017 number less my 2018 number. As you can see, my change in inventory is positive and will increase my cash balance. Next thing I'm going to do here is my change in accounts receivable. Again, my accounts receivable increased here, so I want this to be a negative number. So I'm going to take my 2017 number, subtracting my 2018 number, which will give me a negative number. As you can see, because my change in accounts receivable increased, this is going to be a negative, and it's going to decrease my cash available from cash flow from operations. Now I'm essentially going to flip what I did earlier when it comes to liabilities. If a liability increases, this increases cash. If a liability decreases, this decreases cash. So I'm going to do equals, control page up, go to accounts payable, take my 200 less 350. And essentially what I'm doing is flipping here to show the inverse relationship related to liabilities with respects to assets. As you can see, we've gone ahead and filled all this out, and my cash flow from operations within the period is 370. Moving along, we have our change in debt. So our change in debt is a liability. Liability, if it increases, then it is positive on our cash flow. If it decreases, it is negative on our cash flow. So I'm going to equals, control page up, and look at my debt balance. My debt balance decreased, so I'm going to try to show a negative number. So I'm going to take my 200 less 300, which will give me a negative 100 balance, which shows that I paid off $100 in debt. As you can see, my cash flow statement is beginning to be pretty full out. My beginning cash, we're going to set up a corkscrew here, is equal to my ending cash. Pretty simple. Beginning is equal to ending. And that gets my ending cash balance to be $50. So hopefully you guys are right along here with me. If not, feel free to pause the video and fill this out before we continue on to the balance sheet. Hopefully you guys have finished up the cash flow statement here. We're going to go ahead and move on to the balance sheet. Control page up to get to my balance sheet. First thing we're going to do here is link our cash from the beginning period, from the ending of our cash flow statement, excuse me. Equals, control page down, and I'm going to just grab my ending cash balance of $50. This is the only thing we need to adjust in our current assets. As you can see, our current assets is $1,350. Next, I need to show my PP&E balance. PP&E is interesting because it doesn't our number isn't included here. So another way that we could think about this is plus the difference or the increase in CapEx. So because CapEx increases PP&E, we need to look at this number and then adjust accordingly. So what I'm going to do is go to my cash flow statement, control page down, to look at the sign of my CapEx. So as you can see, my sign is negative. If I was to add a negative number, this would decrease my PP&E. However, CapEx increases my PP&E because that's the money we spent to increase that balance. Because that's money that we spent to increase that balance, we need to adjust accordingly. Control page up to go back to my original balance sheet. So essentially what I'm going to do here is take the previous equals 450, and I'm going to subtract my CapEx. By subtracting a negative, this will actually increase my balance at the end to get 600. Another thing we need to keep track of is our accumulated depreciation. Accumulated depreciation is the total balance of depreciation on your books for the respective plant, property, and equipment. As we talked about earlier, depreciation is a number that allows us to adjust the value of plant, property, and equipment to what it should be valued at. Additionally, this is a non-cash expense, which is subtracted out of our income statement to reduce our tax liability. However, it's added back and is unimpactful on cash. How am I going to calculate my accumulated depreciation? Well, it's pretty simple. What I need to do is add my depreciation from this period to increase this balance to further adjust the valuation of my plant, property, and equipment. So doing the same thing I did here, I need to look at my cash flow statement or my income statement and look at what the sign of the number depreciation is before adding it to the balance. Control page down gets us to our depreciation and amortization balance, and it's a positive 70. Control page up to get back to my balance sheet. Because it's positive, if I just added 70 to 90, this would actually decrease my accumulated depreciation, which is not what I'm looking to do here. So equals my negative number less my depreciation for the year, which is 70. This will increase my accumulated depreciation to 160, which adjusts the balance of the plant, property, and equipment to what it should actually be. As you can see, our total assets for the period is 1,790. Now, thankfully, the rest of the balance sheet is almost filled out for us except for retained earnings. Retained earnings can be increased from net income or decreased from dividends. So the first thing I need to figure out is, did we pay dividends? The best way to figure that out is to look in my cash flow statement. Control page down. And it looks like we did pay out dividends. We paid out dividends of $10 in 2018. Next thing I need to look at is my income statement. Did I incur income? Yes, I did. I incurred income of $500. So in order to do this, I need to increase my balance from the income and decrease my balance from the dividends while adding it to my previous retained earnings. So I can do that by doing equals retained earnings plus control page up to grab my net income for the period plus my dividends. Now it's important you say plus your dividends because dividends is a negative number. If you subtracted your dividends, this would actually increase your retained earnings and cause your balance sheet not to balance. After I press enters there to calculate my retained earnings balance, as you can see, my whole entire balance sheet balances, and I get total assets of 1,790 equals 1,790 for total liabilities and equity. Now feel free to go back and practice this on your own a couple times. That way you can see how the financial statements link and make sure that you can do this on your own because this is a really important concept to know for valuation. Going back to today's slides for today, some key takeaways that we need to talk about as far as the three statements goes. It's very important to know how they all link and what goes into each of the three statements. Thank you guys for staying through today's class. Next week, we'll be going over financial topics. Enjoy the rest of your day. Thanks, guys. Bye.